Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that will move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. Wall Street is seeing red, with stocks under some pressure Friday after a weaker jobs report. At the end of the session, all major indices did end the day lower. And forget the Hollywood breakup, it's the corporate breakup that may unlock hidden value. We're taking a deep dive into that trend. And the American dream is getting much, much more costly. We're looking at new data on what makes the U.S. a happy and how much money you're going to need to get there. Well, the American dream in 2025 cost a whopping $5 million. This is $600,000 more than it did last year. It's according to an Investopedia study that estimates the lifetime cost of 8 major life categories commonly associated with achieving the American dream. This includes retirement, home ownership, and healthcare, among other categories. Joining me now, I got Caleb Silver, editor-in-chief at Investopedia. Caleb, always great to see you. So the American dream is going to cost $5 million. Let's start there. How do we define the American dream? Walk us through it. Walk us through the criteria.
Yeah, great question. And everybody's dream actually has a different price tag. Yours is different than mine. But we looked at what people want, the wants, not the needs. And we actually surveyed our readers and beyond to find out what are the essentials for you that would make you consider yourself financially stable, that you finally made enough to be able to make those types of decisions. And you mentioned a lot of them. We were talking about retirement, healthcare, owning a home, potentially having 2 kids, sending them to college, having a new car every 10 years, having a pet. Pets get very expensive, my friend, marrying somebody off. So looking at an annual vacation, all these things priced in today's dollars, these things add up to about $5 million plus. The thing is, as you know, if you make the median income throughout your whole working life, 25 to 65, you get to around $2.3, $2.4 million depending. There's that gap there. Again, everybody's price tag is different, but these are the things that most people associate with, if I've done the work, if I worked hard, if I've saved, this is what I should be able to have. Again, the wants, not the needs.
Pets are expensive, by the way.
Absolutely.
I mean, my vet took a few teeth out of my dog. I didn't know she had teeth. Thousands. It's thousands, Caleb. $5 million. How does that compare versus last year? It went up 600,000?
Yeah, but we also added a little bit more around healthcare because we took healthcare at a base level in our initial surveys the last couple of years, but we know that people, by asking them through the survey, are thinking about premium healthcare in case something happened beyond the very basic. So that's very important to American families, and they said as much, and that is about $414,000 over a lifetime. Again, these are lifetime costs, adult lifetime costs. And you look at retirement, $1.6 million. That would give you around $67,000 to $68,000 a year for 20 years after the retirement age of 65. Again, for some people, not nearly enough. For some people, too much. But it all depends on what it costs to be the you that you want to be. And that's how we boiled this down.
The $5 million, how does that compare to sort of the lifetime earnings of most Americans?
Yeah, it's about 2 to 3 million higher than most people are going to earn, which is why we need to invest. How do you fill the gap? You fill the gap through investing, through saving, through owning assets. And if you're not investing or you don't have asset ownership, it's very hard to cross that threshold into the feeling wealthy, that sense of I can make decisions based on what I need to do for what's best for my family without worrying too much about money.
What kind of education do people typically need to hit that $5 million bogey?
Yeah, well, education usually helps, but we've seen some softness for people that have college degrees, but it's not just about that. It's about increasing your income over time and then paying your future self through the investing part, which is why we stress it so much and which is why that number is the biggest one out there next to home ownership. Now, not everybody wants to own a home, not everybody can own a home, but if that is part of your plan, you better budget $900,000 at least over, again, the lifetime of owning that home, because the median price is around $415,000. You know, in different parts of the country, it's a lot more than that. Again, these are the base levels of this, and your dream, the important thing is to find your own number and work your way back from that.
Does everybody, Caleb, typically have to be working in the house to hit that dream? Is it a dual income?
Household income. And that households, can be 2 to 3 plus people. We're also talking about having a couple of kids and then eventually sending them to college. Kids from the toddler age up until you send them to college, through college, that can cost quite a bit. When you think about camp and you think about childcare and all the things that go with it, again, not everybody wants these things, but in our surveys, most people identified with these categories, and then I got to put a price tag in today's dollars, given inflation, for a lot of the things that have gone up more than inflation: housing prices, college tuition, et cetera.
Now, here we're talking about national averages, Caleb, right? But the cost would, of course, vary depending on where I live in the country.
Absolutely. If you want to do this up in Greenwich, Connecticut, you know you're going to need to add some commas onto that $5 million. If you want to do this in other parts of the country, it's more affordable. If you want to send your kids to community college or state school, or maybe you get a scholarship or financial aid, it looks different. The reason we do this is because everybody's talking about the loss of the American dream, or lamenting it, or saying it's out of reach. Well, know what that reach is by determining what your number is. Again, what does it cost to be the you want to be? Work your way back from that. It might not be $5 million, it might be lower, it might be higher.
Finally, before I let you go, I always like to get a quick pulse check from you. The Investopedia audience, all those Investopedia fans, just how are they feeling about the markets right now?
Yeah, the smartest.
Cautious, constructive, what do they think?
Yeah, these are the educated investors. Cautious and constructive, enjoying the all-time highs, but worried. And they're seeing...
What's on the worry list?
The worry list is the economy right now, and the impact that we really haven't felt, but we're starting to feel about tariffs. And then, well, what happens when the economy and the stock market, which are very different, really head the other direction very quickly. And I feel like we're at that point where you're kind of feeling the pull in two different directions here. This bubble up of asset prices, good for the shareholder class, good for asset owners, but the real economy, as we know through the jobs report and other anecdotal data, that is souring. That said, they're positive, they stay smart, and on behalf of the Investopedia readers, I'm going to give you a pair of Investopedia's famous socks, because
it comes with the merch.
These will make you a smarter investor.
Fantastic. Thank you, my friend. Appreciate it.
You got it.
All right. Thank you, Caleb. And stick around. Much more As for a Trend still to come. These are great. Is the breakup boom Wall Street's new obsession? Investors are betting that splitting companies into smaller, sharper pieces can unlock hidden value. And senior banking reporter David Hollerith joins us now. David, explain this trend for us.
So Josh, what's going on here is we've seen a huge rise in breakup activity this year. And there's a lot of different reasons for why that is, but typically it's some kind of divestiture activity. It can be what's known as a carve out, where you're just selling a piece of a company's business to someone else, a spin-off where they take a piece of a company and try and IPO it, or just a complete split.
Is this corporate breakup theme and trend you wrote about, are you seeing it more in certain sectors and industries than others?
Yeah, so it's actually interesting. The data is a little bit delayed. TMT is where you see the most breakups this year, followed by what you call diversified industrials. And that's like primarily automotive, energy, and manufacturing. But the thing that we've seen the most, like in the past 2 weeks, has been food and beverage. Kraft Heinz is obviously the biggest news. They're split this week. And then also Keurig Dr. Pepper, they're doing this two-step plan where they're going to sort of buy a company, and then with plans to basically spin out their own coffee business with the company they bought, Peet's, and do an IPO.
What about the role of activists here? I would imagine that's another part of the story.
Yeah, it's interesting. I don't think it's a coincidence that you see higher activist demand and higher breakup activity this year. And you don't have to have both at the same time, but oftentimes activists are looking to breakups as a part of their playbook. Like an obvious reason for why is that a banker was explaining this to me today, is that there's kind of just more mechanical certainty if you're an activist investor getting a return on your money if you call for something like a breakup, because when companies do split, there's some sort of re-rating that goes on. It's not always the case that it's a positive re-rating, but it's more of a sure thing they can bet on. So generally activists have a couple ideas for how to improve a company, and one of them is almost always this year doing some kind of breakup.
When you talk to bankers and you ask them whether this trend is going to continue, what do they say, and what are the variables that depends on?
Yeah, I mean, one variable is that you just got to be careful about asking a banker if they're going to see more business or not. But I mean, I would say they say that breakup activity is going to continue to pick up. And the primary reason why is once you see one company in a sector do it, it kind of creates a cascade effect where investors and shareholders will essentially be saying, why aren't you doing something like this? They're getting better returns, or their stock might be improving.
In other words, it kind of feeds on itself.
It feeds on itself.
Yeah.
It becomes a fad. And that's kind of been coming back this year. It kind of goes back to this thing, Jack Welch, who broke up GE years ago, and also put it together years before that. He had this kind of mentality, which is if you can't be number one or two in a market, you should get out of it. And that kind of tone is definitely in vogue right now.
All right, David, thanks so much. Appreciate it. Stick around, much more Ask for a Trend still to come. Today's market focus has been on that August jobs report and the weaker than expected print, but let's focus in on Main Street, check the pulse of small and medium-sized businesses, plus how AI is likely to change the landscape. My colleague Jared Blickery spoke about this with John Waldman, Homebase founder and CEO.
I would say the report this morning was pretty consistent with the data that we see across 150,000 plus small businesses and 2 million plus workers looking at these trends in real time. What we saw this morning first was that payrolls were essentially flat, and that so were wage rates. And that has been pretty consistent with what we've seen over the summer, which has been a pace of caution from small businesses really going back since the start of the year.
Well,
yeah, go ahead.
I'm sorry, go ahead. You were about to break some stuff down.
Yeah, I was going to say, second, we saw the downward revisions in the historical numbers, and frankly, that was very much expected. We have been seeing that caution all year, and so that was not a surprise at all. I think the one thing that was a surprise for us under the covers here was that we saw a 17% jump in turnover and a 10% jump in hiring. And so while the overall numbers were staying relatively flat, we were starting to see a higher level of churn in the system.
That's interesting. We were just talking to an economist, and she was talking about the market being frozen on both sides for certain groups of people, people who are looking for work and also people who are trying to get workers. Anything you're seeing like that in your data?
Yeah, we serve small businesses, and they're subject to a lot more seasonality in the hiring that they do. But the other thing that's true is these are businesses that respond very quickly. That's one reason why the Main Street data that we provide has been so predictive of these larger trends, is because small businesses are very quick to react to changes. And so when we see them operating with caution in the face of economic uncertainty for most of 2025, that's not a huge surprise. When we see them potentially recalibrating their teams a bit in this current opportunity where there is a lot of seasonal turnover, that's maybe not a huge surprise either.
And let's break it down by some of the sectors. I'm reading your report right now, and you in particular note that entertainment and caregiving are facing stronger headwinds.
Yeah, I think some of that's normal with the seasonality on the entertainment, but I think it's consistent with, frankly, what your previous guest was just talking about, which is, some concerns in the softness of consumer spending. That's going to flow through to things like entertainment. And again, small businesses operating in these categories are going to be some of the first to respond to that.
And what about some of the indicators like temporary work and wage growth? Those are things that we always look at in the BLS monthly report. How does that compare to what you're seeing in your data?
Yeah, I think that's something everybody should be paying attention to. I thought it was quite notable in July when we actually saw the average hourly wage decrease month over month, which is something that we hadn't seen for a long time and really off trend for the last few years. And so I think as we look at the slight decline last month and basically flat this month, I think that is actually telling us that something significant is changing in the labor market.
All right, and let's talk about AI here. There are a lot of fears about AI coming for jobs, and of course they're going to create some jobs as well, but the headlines is usually when jobs are being lost to this new technology. How do you see that evolving in your data set?
Yeah, you remember back in 2021 when everybody was talking about the K-shaped recovery and
Sure.
you had these really divergent paths on the economy. I think that we might be in the midst of seeing something like that again, very divergent paths. In large companies, we are hearing a lot of talk about AI-driven layoffs. In small businesses, I do not think that is what you're going to see. I think AI is a profound enabler for small businesses. Already we are seeing record growth in new business applications. That's been really strong for a while. But break down what is ahead. AI is a fundamental time saver for small business owners who are so stretched. And I'll give you a recent example.
Please.
I was talking to a customer who is using our AI-driven hiring assistant to create their team as they open their business. They interviewed over 64 applicants in the first 24 hours. That saved him over 30 hours of time and was an incredibly fast hiring process. You can't tell me that AI is not going to be an enabler for growth for very busy small business owners.
And
Yeah.
Sorry to interrupt you there. And I was just going to add, AI really helps businesses navigate all kinds of complex regulations, fill out forms. What are some of the other areas where you see AI really enabling small business owners, especially in a regulatory environment where regulations are kind of being cut right now?
I think you're pointing at one of the most important things and where the biggest gains to small business growth are still ahead of us. Right now, small business owners get to harvest the benefits of time savings and all of these incredible things that AI can bring to them. But we know that one of the incredible limiters to small businesses and entrepreneurs is the incredible complexity of starting a business. Anything that can reduce that complexity is going to enable more entrepreneurs to build, to pursue their dreams. And I think that is the great promise of AI ahead, where AI is going to be that true enabler, when it can really reduce that barrier in handling all of the complexity and regulation and just the operational hurdles of starting a business.
Yeah, and John, I agree with you. We are just at the beginning of this big AI ramp. Thank you for joining us. Appreciate your insights.
Thanks for having me.
That's a wrap on Asking for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.